Welcome to today's video on crafting an unconventional yet resilient path to early retirement using defined benefit pension power. First, we will set the stage. Many near retirees experience success paranoia even with strong finances. Rather than asking if you have enough, a better question is whether your income is guaranteed, inflation-aware, and sufficient to cover your healthcare gap. Now, let's outline exactly how to turn a powerful pension into reliable independence and mitigate the biggest risks along the way. Next, here's our roadmap. We will begin with a mindset shift, then move into the mechanics of defined benefit pensions and why replacement ratios matter. After that, we will examine how a cost of living adjustment protects you from inflation. Then, we will stress test the budget transition from a $150,000 salary to roughly $7,500 per month net pension. Moving forward, we will cover the healthcare gap from age 55 to 65, discuss debt elimination and liquidity, and finish with an action plan and brief case walkthrough. Finally, we will test your knowledge with 2 quick quizzes. Before we dive in, a quick disclaimer. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Your personal situation may differ significantly, and pension rules vary by plan and jurisdiction. Please consult a qualified professional who understands your exact benefits, taxes, and healthcare options before taking action. With that established, let's proceed. First, let's address success paranoia. Even with a strong pension, it is normal to worry about outliving money or unexpected costs. Instead of ruminating on whether you have enough, reframe the goal. Build an income architecture that is guaranteed, resilient to inflation, and sufficient to cover healthcare risks. With this mindset, decisions become systematic rather than emotional. Now, let's discuss the power of a defined benefit pension. Now, consider the power of a defined benefit pension. Paying $8,100 per month. After taxes, the net could be approximately $7,500, though your actual net depends on your location and withholdings. This level of guaranteed, lifetime income often exceeds the classic 70% replacement ratio guideline, which is a common benchmark for retirement security. While long-term sustainability of certain public plans is debated, from the recipient's perspective, the benefit is a contractual guarantee that underpins financial independence. In practice, this net amount covers fixed expenses, the healthcare bridge, discretionary spending, and your essential sinking funds for home, auto, and medical needs. Next, let's make sure this income keeps pace with rising prices. Next, verify whether your pension includes a cost of living adjustment and understand how it is calculated. Is it tied to CPI, capped at a certain percentage, or delayed? Without a cost of living adjustment, inflation can erode purchasing power significantly. For example, with 3% annual inflation, purchasing power can drop by roughly 45% over 20 years. If the adjustment is partial or capped, you will need to build additional buffers such as cash flow surpluses, inflation-protected securities, or staged income sources. Be sure to document expected annual adjustments in your retirement policy statement to monitor your real income over time. Now, let's pressure test the budget transition. Now, let's stress test the budget. Start by setting your current working net income, and then constrain yourself to the anticipated net pension of approximately $7,500 per month. Keep your mortgage as a line item until it is fully paid. Add realistic allocations for healthcare premiums and an out-of-pocket medical buffer to reflect the decade before Medicare. Maintain sinking funds for home maintenance and auto replacement, and continue contributions to emergency savings to keep liquidity strong. Track whether the test drive budget generates a small surplus, which can be routed to accelerated debt payoff or additional savings. Next, we will detail exactly how to run this test drive. Moving on, run a 90-day budget test drive. First, limit yourself to spending the equivalent of your projected net pension by redirecting the excess of your current paycheck into savings automatically. Second, implement spending caps that match your target categories and enable alerts so you do not exceed them. Third, include simulated healthcare premiums and a monthly out-of-pocket medical reserve. Fourth, track actual spending weekly and adjust category limits as needed, but do not alter the overall goal. Fifth, route any surplus directly toward extra mortgage principal or emergency savings to strengthen your liquidity. Sixth, resist lifestyle creep so that your spending pattern matches the retirement reality. Finally, at the end of 90 days, evaluate the results and formalize a written spending policy. Next, let's address the healthcare gap between ages 55 and 65. Budget not only for monthly premiums but also for the maximum out-of-pocket exposure each year, recognizing that medical costs can cluster. If you are retiring from public service, confirm whether you can use pre-tax retirement funds to pay health insurance premiums without penalties, which can materially lower your after-tax cost. Additionally, plan the timing of elective procedures when your coverage, deductible cycle, and personal recovery window align. Finally, set annual reevaluation checkpoints up to the Medicare transition at 65. Now let's clarify the role of your 457 plan, which in this case is approximately $275,000. Treat it as an emergency buffer and avoid tapping it unless primary income is inadequate. If your plan permits, you may be able to use pre-tax funds to pay health insurance premiums prior to 59.5 without penalties, especially in public sector contexts. Sequence withdrawals after pension income and other taxable cash flow sources to minimize unnecessary taxes. Most importantly, keep this reserve liquid and conservative. This is a safety asset rather than a return-seeking asset. Next, let's convert debt into flexibility and review liquidity. Next, eliminate the remaining $30,000 mortgage as soon as practical to transform mandatory payments into discretionary cash flow. Maintain more than 6 to 12 months of core expenses in liquid accounts such as money markets, high-yield savings, and short-term treasury bills. Keep distinct sinking funds for predictable big-ticket items like vehicle replacement and home repairs. The combination of cash liquidity and physical mobility becomes a crucial, non-financial asset that defines the quality of retirement. Now, let's test your understanding with a quick quiz. Question 1. What is typically the greatest financial risk for early retirees between ages 55 and 65? Option A, healthcare coverage costs before Medicare eligibility. Option B, market volatility in a balanced portfolio. Option C, travel and leisure expenses. Option D, car depreciation. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is healthcare coverage costs before Medicare eligibility. The 10-year span from 55 to 65 often carries the largest and least predictable combination of premiums and potential out-of-pocket costs, especially when ongoing health needs or elective procedures are involved. Next, let's walk through an example month to see how the cash flow works. Now, let's walk through a single month. First, the pension pays $8,100 gross, and after taxes, the net of approximately $7,500 arrives. Next, the budget prioritizes healthcare premiums and an out-of-pocket buffer before other items. Then, any remaining surplus is directed to additional mortgage principal and sinking funds for home, auto, and medical needs. Finally, allow a modest discretionary category to maintain quality of life and reduce the temptation to overspend elsewhere. Before we summarize, here is a second quick quiz. Question 2. If your pension has no cost of living adjustment and inflation averages 3% annually, what happens to purchasing power after 20 years? Option A, it erodes by roughly 45%. Option B, it stays the same. Option C, it increases with inflation. Option D, it doubles in real terms. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that purchasing power erodes by roughly 45%. At approximately 3% annual inflation, the real value after 20 years is near 55% of today's value, which implies around 45% erosion. Therefore, verifying or compensating for COLA is essential. Next, let's consolidate everything into a strategic map. This mind map centers on the early retirement strategy and branches into 7 pillars. The pension branch emphasizes gross and net amounts, lifetime guarantee, and meeting or exceeding a 70% replacement ratio. The COLA branch covers verification of CPI linkage, potential caps or delays, and the erosion of purchasing power if absent, along with countermeasures like cash flow buffers and inflation-protected instruments. The healthcare gap branch highlights budgeting for premiums and out-of-pocket maximums, timing of elective procedures, and the potential to pay premiums pre-tax in certain public sector plans. The budget test drive branch outlines a 90-day simulation with strict category caps and routing surpluses to mortgage payoff and liquidity. The 457 plan branch clarifies that it serves as a preserved emergency buffer with tax-aware sequencing. The debt and liquidity branch focuses on eliminating the remaining mortgage, maintaining 6 to 12 months of cash, and keeping sinking funds. Finally, the quality of life branch emphasizes mobility, necessary surgeries, and maintaining a modest discretionary buffer. To summarize the key points, prioritize guaranteed income and then optimize for returns. Treat COLA, or alternative inflation buffers, as essential. Run a 90-day test drive at the net pension level. Price the healthcare bridge precisely by including premiums and potential out-of-pocket maximums. Eliminate remaining debt and keep substantial liquidity to maintain peace of mind. Preserve your 457 plan as a safety reserve rather than a return-chasing vehicle. Finally, recognize that health and mobility are assets worth investing in. Now, let's wrap up. In conclusion, a strong pension can deliver practical independence when paired with clear inflation and healthcare strategies. Budget realism, achieved through a test drive, is more valuable than any spreadsheet projection. Finally, sufficient liquidity transforms surprises into manageable inconveniences rather than crises. Before you go, here's a final note. Thank you for watching. If this video helped you, please like, share, and subscribe. Tell us in the comments what your biggest early retirement concern is, and we will address it in future videos.